Hey folks, it's Dr. Jeff Camarda with a piece called Stock Market Deja Vu all over again. Yogi Berra, great sage of the Bronx, had a lot to teach about the market if only he would have said it. Like maybe investing is 90% mental and the other half is not losing money. Unlike my misquote here, he actually did say slump. I ain't no slump, I just ain't hitting. Lots of old school investors and advisors, and when I say old school, I mean the apparent minority, like us, that actually schooled themselves on investments before picking up a bet and advising people, may be commiserating with Yogi on that one. Since the bottom of the market way back in 2009, the basic precepts of best practices portfolio management, asset allocation, wide and global diversification, regular rebalance and adjustment may seem as old school as Socrates. Used to be, you want a little piece of this and a little piece of that to spread the risk and enhance the chances of gains. But not no more. Now that this time seems to really be different, the S&P 500, led by U.S. large cap growth, has been the place to be. Consider, for the 5-year period ending Q3 of 18, the S&P 500 turned over 11%, while the MSCI World, the index, ex-USA, showed less than 2%, and the MSCI Emerging Markets Index brought back a paltry 0.8%. Yep, that's less than 1%, folks, not the 7.8% the decimally hopeful or decimally challenged might see. U.S. stocks returned over this period something like 6 times more than non-U.S. stocks, like those in Canada and Australia, and like 15 times more than emerging markets like Brazil, India, and most of Asia. So why are the old school guys sticking to their non-U.S. diversification guns, even in the wake of such dismal relative underperformance? It's more than fiddler on the roof type tradition. Beyond the hopefully obvious benefits of monoportfolio theory style diversification, crusty old school investors like moi and advisors want to make lots of money over the very long term. That's why they do it. While the U.S. markets have been kicking butt lately, it was not so long ago that the tables were turned and the old school money had bragging rights. From 2000 to 2009, U.S. stocks dipped over 9%, while non-U.S. markets soared from 17 to 213%. Talk about you ain't over till it's over. What's more, this was no flash in the pan Bronx cheer. For the 11 decades beginning in 1900, the U.S. stock markets beat the non-U.S. markets 5 times, but the other guys did better 6 times. And the more that things change, the more they stay the same. Nothing goes up forever, and U.S. stocks, by many measures, are very richly valued. Dare one whisper, may be overvalued and may be ripe for a fall. Maybe not this year, maybe not next, but surely sometime soon, if history has anything to say about it. Moreover, whilst U.S. stocks soar like as if on wings of the babe, valuations of many non-U.S. stocks look real cheap. I mean dirt cheap. If you ain't old school already, it just might profit you to take another look in the schoolhouse while the sun yet shines. Hope you enjoyed that. Until next time, this is Jeff Camarda. We'll see you.